Hi, my name's Eric. I'll be reading you selections from this week's Barrons magazine, dated January 5th of 2026. This reading is produced for people who are blind or print disabled by the Audible Local Ledger, a reading service located in Mashpee, Massachusetts. We will start with Up and Down Wall Street. This is written by Ben Levison. Your exuberance is irrational. The market is headed down. If last year was full of fireworks that ultimately resulted in another big gain for the stock market, 2026 appears set to be a dud. Looking back at 2025, the fact that the S&P 500 index gained 16% feels like a small miracle. The Donald Trump experience has led to wild swings. Who can forget the near bear market in April after the president announced the first iteration of tariffs? But also big profits. It didn't hurt that the artificial intelligence trade remained a strong, if uneven, theme during 2025, helping tech stocks lead the market higher once again. It wasn't quite what Wall Street expected either. Strategists had been predicting a 7% rise in 2025, with a declining multiple forecast offsetting strong earnings. History, however, shows that the S&P 500 rarely gains 7%, so we took the over. We predicted another year with a gain of close to 20% following large advances in 2023 and 2024, driven by strong earnings, AI, deregulation, and fiscal spending. We also forecast a heaping dose of policy-provoked volatility. We would have looked like geniuses except for the fact that we later turned bearish at the height of April's tariff scare. This year, Wall Street strategists expect the S&P 500 to gain about 9.6%. That seems unlikely. Going back to 2015, the S&P 500 has gained about 9% just once in 2016, when it rose 9.5%. Otherwise, the index had two bad years. It lost 0.7% in 2015 and 6.2% in 2018. One terrible year, a 19% decline in 2022, and a bunch when it rose more than 16%. For Dean Yulkin, CEO of specialty finance firm Cardiff, one of two outcomes is most likely. Either conditions deteriorate and returns disappoint, or risk premiums compress and returns exceed expectations, he writes. The clean, moderate outcome is often the least common. He expects another great year in 2026. We're taking the under. The problem is that 2026 is a midterm election year. From a market perspective, we could care less who wins. What matters is that such years have historically been the worst of the presidential cycle, with the S&P 500 finishing the year higher just 53% of the time and with an average gain of just 4.6%, while the other 3 years finished up 78% of the time with an average gain of 11%. Part of the issue is that much of the good that a president accomplishes occurs during the first year of a term, and it's immediately priced in. And that's the pattern from Trump's first term. The S&P 500 gained 19% in 2017 before its 2018 tumble, and is likely to happen again during Trump 2.0, even after the tax cuts and fiscal spending bill that became law last year. While the fiscal largesse may already be reflected in stocks, it should start showing up in the economy in 2026, and that highlights the next big risk. Not that the U.S. will sink into recession, but that growth will be stronger than the 1.8% that economists expect. They've already made a habit of underestimating economic strength and finding reasons to explain it away, and they could be expected to follow that pattern again this year. The markets would initially take that strength as good news, argues T.S. Lombard's Dario Perkins, until inflation concerns take over. Then the question would turn to whether the Federal Reserve would have to start raising interest rates, the dreaded tightening cycle, or ignore it. In the case of the Fed, if there's no appetite for policy tightening, investors will start to wonder about the central bank's independence, Perkins writes. Don't expect the AI trade to save the day. For 3 years, big tech has been able to cover up the flaws in the market, lifting the S&P 500 regardless of the headlines. Cracks started appearing in 2025. Only Nvidia and Alphabet outperformed the benchmark last year, though strength in Broadcom and others helped make up for it. More worrisome were signs that investors were starting to worry about the money being spent on AI, punishing big borrowers like Oracle and CoreWeave over the last 3 months of the year. That's not to say that the AI trade is over. It will continue to be a big theme for years to come. But it's getting more complicated. It's making stock selection far more important. The choke points are likely to be physical. Not every company will be rewarded equally. Consider, during the last 2 months of the year, companies on the receiving end of Google's spending outperformed OpenAI's beneficiaries, according to 22V Research's Dennis DeBuscher. We don't expect a bad year. That would require something, bad, such as the bleak picture painted by Peter Barrons, chief global strategist at BCA Research, in a note that purports to look back on 2026 from the beginning of 2027. AI adoption starts to slow. Companies cut spending on AI. Stocks start to fall, and consumers cut spending because of a reverse wealth effect, causing global economies to sink into recession. The S&P 500 would finish the year at 5280, down 23%. We're more optimistic, but with stocks less correlated and no big drop to act as a springboard for further gains as occurred in 2023 and this past April, another high teens gain seems unlikely. We'd expect a relatively flat year, with the S&P 500 finishing down about 2%. At least it won't be a bear market. Moving on to the Streetwise column, authored by Jack Huff, the suddenly sexy 3 memory stocks beat the Mag 7. Can it last? The Magnificent 7 got trounced in 2025 by the suddenly sexy 3 hard drive and memory makers whose stock prices tripled. Can the 3 shine again in 2026? History says don't count on it, but today's oligopoly control in memory says maybe. Until recently, Seagate Technology, Western Digital, and Micron Technology were best known among investors for turning up on deep value screens. If you had ranked S&P 500 index members by price-to-earnings ratios on New Year's Day of 2025, Western Digital would have come in 10th lowest at 8.2, making it just cheaper than Bunge Global, whose main business is soy processing. Now, I don't want to downplay the importance of bean squeezing, but you would think nanoscale clean room manufacturing of a data center essential would command a higher valuation. Micron then ranked 53rd cheapest in the index at 11.2 times earnings, and Seagate 59th at 11.6 times. All of the suddenly sexy 3 make computer memory of sorts. Western Digital and Seagate make long-term storage, or what's called non-volatile memory, meaning the data stays when the power is turned off. This includes hard disk drives, or HDDs, with magnetic storage on spinning disks, and solid-state drives, or SSDs with no moving parts. Western Digital spun off its SanDisk SSD business last February, but still has a stake. HDDs lead on cost and capacity, and SSDs on pretty much everything else. The industry's first 1 terabyte HDD was announced at the start of 2007. Today, Seagate's top HDD platform for hyperscale customers has capacities over 30 terabytes, with a focus on power and heat management, and its next generation later this year will push capacities over 40 terabytes. Micron mostly makes working or volatile memory called dynamic random access memory, or DRAM. It also makes long-term storage for SDDs called flash, or NAND, N-A-N-D, which stands for not and, a reference from the world of ones, zeros, and Boolean logic. We haven't yet reached the final circle of acronym hell, Let me take you there now. Micron, in its latest quarterly report, mentions HBM, TAM, CAGR. HBM stands for high bandwidth memory, a zippy, costly kind used for artificial intelligence. If regular DRAM is a highway, HBM is a racetrack. TAM is total addressable market, and CAGR, CAGR, of course, is compound average growth rate. Micron's point in stringing together this alphabetical atrocity is that the market for one of its most lucrative products could see 40% yearly growth through 2028, from $35 billion to $100 billion. And this gets to the core of the matter. AI is driving runaway demand for processors like those NVIDIA makes, but they would be paperweights without memory. So demand there is going bananas too. There have always been demand spurts for hard drives, from personal computer adoption in the 90s to digital music and video in the 2000s, and streaming and cloud computing in the 2010s. Today, AI is creating and consuming vast amounts of data. Think of the video generated by cars with autonomous or advanced driver assistance features. Western Digital reckons that data generation will triple over the next few years, and the percentage of data that companies hang on to will rise from low to mid-single digits. In the past, memory supplies would tighten, prices would surge, and desperate customers would double order, giving the illusion of even higher demand. And then when demand slowed, customers would end up overstocked, prices would plunge, and memory makers would fall on hard times. As upswings go, this one's been a doozy. Western Digital, Micron, and Seagate were numbers 1, 2, and 3 in the S&P 500 for stock performance in 2025, returning 282%, 239%, and 219% respectively. Profits look pornographic. Micron recently predicted 68% gross margins. Morgan Stanley thinks HDD gross margins can top 50% in the year ahead. For comparison, Apple's poshly priced gadgets and services recently generated a gross margin of 47%. Analysts, who are overwhelmingly bullish on the memory stocks, say supplies will remain tight through 2026 and beyond. This time it's different. John Templeton famously called those the 4 most dangerous words in investing. But how soon will history repeat? Western Digital and Seagate trade at price to earnings in the low 20s. Still a slight discount to the market, despite forecasts for rapturous earnings growth. Micron, whose earnings have shot up faster, goes for just 9 times earnings. If something is different this time, at least for now, it's the competition. There have been hundreds of memory makers over the years, but due to failures and consolidation, we're down to 3 that matter. In hard drives, these are Western Digital and Seagate, each with about 40% of the market, and Toshiba, with close to 20%. In DRAM, Korea's Samsung Electronics and SK Hynix have a 1/3 share each, and Micron has about a quarter. On a related note, the iShares MSCI South Korea Exchange Traded Fund returned 95% in 2025. Oligopolies can and do fall into price wars or production gluts. If you've heard of game theory, or the prisoner's dilemma, or Nash equilibriums, or the 2001 movie A Beautiful Mind, all of these relate to the idea that even markets with only a few participants are prone to mutual shin-kicking. The solution for that is collusion, but it's illegal in market economies. The legal solution is for firms to follow one another's lead without formal agreements. We've been quite clear and explicit to say, as things stand, we are not adding any unit capacity, said Western Digital's CEO at a December conference. Our focus is really on improving a real density. It could be a busy month for the Suddenly Sexy 3. The Consumer Electronics Show is January 6th through 9th. At last year's show, NVIDIA's CEO praised Micron memory and sent the stock 10% higher in a day. The hard drive makers report quarterly results in late January, around when the Mag 7 giants might comment on data center spending plans. Western Digital tends to hold an investor day in early February, and for tax reasons, it's likely to sell the rest of its SanDisk stake before February 21st and pay off more than half of its $2.6 billion in net debt. Moving on to what happened last week and what's supposed to happen this week in the review and preview section in Barrons of January 5th. A red flag for silver. Are silver prices in a bubble? Silver was up more than 140% in 2025 to $70 an ounce, making it the year's top-performing financial asset. Meanwhile, oil prices last year slid nearly 20% to $58 a barrel, producing a historical rarity. An ounce of silver now costs more than a barrel of oil. DataTrek research says that the only other time an ounce of silver cost as much as a barrel of oil was in January of 1980, when the famous attempt by the Hunt brothers to corner silver sent the metal spiking to $50 an ounce. The average oil-to-silver ratio since 1975, notes DataTrek co-founder Nicholas Colas, is 3.8. So a normal price for silver with oil at $58 would be closer to $15 an ounce. Or oil prices would need to rise to 3.8 times the price of silver to nearly $290 a barrel. Either way, something has to give. Still, some experts believe that silver's rally can continue. Sentiment trader analysts note that silver is benefiting from uncertainty in the global monetary system and expectations of lower real rates, which has helped propel gold prices to highs as well. Alex Kupsikevich, foreign currency broker for FX Pro's chief market analyst, calls it a silver bubble, despite it being far from the 1980 inflation-adjusted high of about $200 an ounce. Silver has the habit of becoming a hot ticket once every 10 to 20 years, Colas says, and during those periods it's very hard to call a definitive top since investor enthusiasm can remain elevated. And that was reported by Paul R. LaMonica. What happened last week in markets? New Year's week began with markets cool and geopolitics hot. President Donald Trump shuttled between Russian President Vladimir Putin and Ukraine President Volodymyr Zelensky, then talked Gaza with Israeli Prime Minister Benjamin Netanyahu as China ran live military drills around Taiwan. Trump also renewed his threats to fire, quote-unquote, Federal Reserve Chief Jerome Powell and kicked his decision to announce a successor to January. Stocks sank, precious metals fell back. It was a short, if bearish, week with the Dow Industrials down 0.7%, the S&P 500 down 1%, and the Nasdaq Composite down 1.5%. For 2025, the Dow finished up 13%, the S&P up 16.4%, and the Nasdaq up 20.4%. In companies last week, the Education Department dropped its designation of accounting as a profession, reducing federal student loan access. China, riding a projected 17% growth in new car sales, appears ready to take first place globally, beating out Japan. Tesla saw 2025 EV, electric vehicle sales, drop 9%. NVIDIA signed a $20 billion licensing deal with Grok for its inference chip technology, which is used to run artificial intelligence applications. Lululemon Athletica founder Chip Wilson launched a proxy contest to reshape the company's board. In deals last week, the Wall Street Journal reported Meta Platforms was buying Chinese-founded, Singapore-based AI company Manus for more than $2 billion. Warner Bros. Discovery's board appears ready to reject Paramount Skydance's takeover bid again in favor of Netflix's offer. And what's happening this week? On Monday, January 5th, the Institute for Supply Management releases both its manufacturing and services purchasing managers indexes for December. Consensus estimates for the manufacturing PMI, released on Monday, is for a 48.4 reading, and for the services PMI, released on Wednesday, 52.2. And this compares with readings of 48.2 and 52.6, respectively, in November. On Wednesday, January 7th, the Bureau of Labor Statistics releases the Job Openings and Labor Turnover Survey. The consensus call is for 7.7 million job openings on the last business day of November, about even with the October figure. On Friday, January 9th, the BLS releases the jobs report for December. Economists forecast a 55,000 increase in non-farm payrolls, following a 64,000 gain in November. The unemployment rate is expected to edge lower to 4.5% from 4.6%. Jobs growth has been sluggish, averaging 54,454 a month through the first 11 months of last year, roughly a third of the increase seen in 2024. The University of Michigan releases its Consumer Sentiment Index for January. Consensus estimate is for a 53.5 reading. Consumers' expectations of year-ahead inflation was 4.2% in December, the lowest in 11 months. By the numbers, 13.1% is the fall in year-over-year profits in November of China's industrial companies with revenue over $2.8 million. 717 is the number of U.S. corporate bankruptcies through November. That's up 14% from a year earlier. It's the highest since 2010. 61% is the drop in U.S. fines for money laundering and sanctions violations in 2025 to $1.7 billion from $4.3 billion in 2024. And $400 billion, the combined sales of the world's largest semiconductor companies in 2025, by far a record high. The next headline: international stocks are on a tear. 7 to consider. Non-U.S. stocks could have another standout year, fueled by rising earnings and falling interest rates. Where to shop now, by Reshma Kapadia. International stocks saw surprisingly strong gains in 2025, with equity markets in export-driven countries such as Korea and China outpacing the S&P 500 index even after the U.S. imposed the highest tariff seen in decades. Non-U.S. markets could rally further in 2026, fueled by falling interest rates and rising corporate earnings. The MSCI AC World ex-USA Index returned more than 32% in 2025, nearly double the 18% total return of the S&P 500. Some foreign markets did far better, with the iShares MSCI South Korea Exchange-Traded Fund up 95% and the iShares MSCI Brazil ETF ahead 49%. A weaker dollar helped returns, but wasn't the only driver. The past year marked the end of a 15-year stretch in which foreign markets lagged behind the U.S., a reversal that could nudge more U.S. investors to look overseas for growth. In many markets, they'll find less richly valued plays on artificial intelligence and electrification and improving economic and financial conditions. Strategists at J.P. Morgan expect double-digit gains in 2026 across developed and emerging markets, spurred by robust earnings growth, lower interest rates, and fewer policy risks, such as tariffs. Bargain-oriented investors such as Warren Chang, manager of the GMO International Value Fund and similarly named ETF, also see plenty of opportunity internationally. In part, that's because non-U.S. markets are still relatively cheap. The MSCI World ex-US Index is trading for 15.6 times next year's expected earnings. That's roughly the same valuation as before its 2025 run. That reflects improving earnings and expanding price-to-earnings ratios, Chang says. The MSCI US Index sports a profit-to-earnings ratio of about 23. Across international markets, there is evidence of an improving backdrop. President Donald Trump's foreign and trade policies sparked a reset in Europe, where policymakers have pledged significant fiscal stimulus, including an increase in military spending. J.P. Morgan's Mislav Matejka, head of global and European equity, expects 10% to 20% earnings growth for the Eurozone in 2026, as earnings benefit from fiscal stimulus and improving financing conditions. Tariff risks diminish, and China's economy shows signs of stabilizing. An end to the Russia-Ukraine conflict would be an added plus. The iShares MSCI Japan ETF returned 26% in 2025, but investors see more room for Japanese stocks to rise. Japan's recently elected Prime Minister, Sanae Takaichi, has business-friendly plans to lower taxes and offer incentives to bolster investment. China's economy is still struggling, as evidenced by November's weak economic data. While Beijing is unlikely to unleash stimulus, recent comments from officials suggest that the government has grown more serious about prioritizing a revival in domestic demand, alongside a continued push for technological self-reliance. China has invested heavily in artificial intelligence, biotechnology, and other technologies. Chinese AI stocks outperformed U.S. AI stocks this past year, but investors aren't fretting about a possible AI bubble in China, says Jitani Kandari, head of macro and thematic research for emerging markets equity at Morgan Stanley. In China, the stock's gains owed largely to rising profits to earnings ratios. Shares will look cheap if earnings growth accelerates, Kandari says. Chinese tech earnings have bottomed after several years of declines, and recent results from cloud companies suggest reasons for optimism. While growth stocks have propelled U.S. indexes this year, value stocks have led markets higher in Europe and Japan. GMO's Chang says he is still finding cheap companies overseas with good businesses, hefty margins, and significant competitive advantages. His top holdings include Germany's Deutsche Bank and Spain's BBVA, and Japanese industrial firms that are benefiting from reordered supply chains and government reforms. Louise Sauerbraun, a manager of the $2 billion Brandis International Equity Fund, favors luxury goods companies such as Kering, whose flagship Gucci brand has been hurt by weakness in China and a poor reception to recent collections. That created an air pocket in the stock, which fell by nearly half in the past 5 years, but then was up 26% in 2025. Gucci, he notes, has recovered from past setbacks, plus Kering has a new CEO, Luca de Meo, formerly of Renault, who is trying to repair the company's balance sheet. Richard Tripp Clattenburg, manager of the $13.6 billion T. Rowe Price International Stock Fund, likes quality stocks, many of which were more expensive and thus overlooked when the rally in foreign stocks started last year. There aren't many times when you get shots at relatively lower risk, high-quality assets, he says. Among Clattenburg's holdings, Unilever, which has new management, a roadmap for volume growth, and a 3.6% dividend yield. Clattenburg also owns Japan's Nippon Sanso Holdings, which makes industrial gases, and has a lower valuation than larger rivals such as Air Liquide. He expects Nippon Sanso to get a lift from Japan's more business-friendly moves, but says the valuation provides a cushion if the global economy starts to sour. Emerging market stocks still trade at a steep discount to the S&P 500, despite a preponderance of technology stocks in these markets. Within China, investors see opportunity in early adopters of AI. China is a super app country. It's harnessing AI in media, e-commerce, gaming, and travel, says Kandari, who says semiconductor and semi-equipment companies, robotics, biotech, healthcare, and consumer-oriented digital platforms are among the beneficiaries. Brandis's Sauerbraun likes the outlook for Alibaba Group Holding, even after the stock's 75% rally in 2025, noting that near-term earnings are depressed because of the company's use of large subsidies to spur growth in its core e-commerce business. But the initiative is showing early signs of success. Alibaba also benefits from its strong position in AI with a full-stack model that provides compute power, a cloud platform, AI models, and applications, he says. India and Brazil aren't AI-focused markets and could fare better if the AI trade loses steam. India's market trailed in 2025 due to the negative impact of U.S. tariffs, sluggish economic growth, and investors' reallocation of assets to China. But T. Rose Clattenburg notes that the government and Reserve Bank of India are both pro-growth. Axis Bank is a private sector bank that's cleaned up its loan book and should be an early beneficiary of an economic pickup, he says. Brazil's market is tilted toward commodities and should continue to benefit from the push for electrification. Inflation is expected to ease, which means that monetary policy could loosen, helping stocks, says J.P. Morgan. Another plus, the Trump administration's focus on increasing U.S. influence in South America could mean more foreign direct investment and an easing of the 50% tariffs Trump imposed on Brazilian goods earlier this year. The Vanguard Total International Stock ETF offers an inexpensive way for U.S. investors to gain broad exposure to international markets, with about a quarter of its assets in emerging markets. The Capital Group International Core Equity ETF provides a broad-based strategy, with about half of its weighting in continental Europe and the United Kingdom. For investors who favor actively managed funds, 3 options include the $986 million GMO International Equity Fund 4, which returned an average of about 25% a year in the past 3 years, beating 99% of its peers, Brandis International Equity Fund, which returned 24% a year in the same span and beat 98% of its peers, and the $16.7 billion T. Rowe Price International Value Equity Fund, which averaged an annual return of almost 22% in the same 3 years, outperforming 86% of its peers, according to Morningstar. The next headline in this week's Barrons, Charles Schwab is back on offense. The company's problems of 3 years ago are well behind it, and its shares looked poised for more gains, by Andrew Welsh. A few years ago, Charles Schwab weathered a storm over its sweep accounts and came through on the other side. Its stock now looks like a buy as the company leans into its traditional strengths and adds new ones. Both were on full display in early November when Schwab CEO Rick Wurster hosted thousands of independent financial advisors who collectively keep trillions of dollars in assets at Schwab at a multi-day conference in Denver. In the middle of the conference, Schwab announced that it was acquiring Forge Global Holdings, which links investors in private companies. If independent advisors and the retail investors they serve are cornerstones of Schwab's business, the Forge Global acquisition is a sign of how Wurster wants to build on that foundation. We want to democratize private investing just as we did public investing, he says. The Forge deal comes as Schwab strives to win more wallet share with customers by expanding its brokerage and advice offerings and branching into cryptocurrencies. The company has made a clear shift from defense to offense, writes UBS analyst Michael Brown, who recently initiated coverage of Schwab's stock with a buy rating and $119 price target. The shares closed on Friday at $101.57. Execution is key, but the strategic pivot to offense reinforces our confidence in Schwab's ability to re-rate. That Schwab was on defense speaks to the turbulent waters the company had to navigate 3 years ago when a sharp rise in interest rates motivated clients to move money out of its highly profitable cash sweep accounts and into money market funds and other options that paid clients more interest but were less profitable for Schwab. Schwab's stock took a hit when the company piled on costly short-term debt as outflows exceeded its cash on hand. That debt subsequently weighed on earnings. Schwab was able to weather the storm until the Federal Reserve started lowering interest rates, and the problem subsided. Today, the company has largely paid down its short-term debt, providing a profit tailwind in the quarters ahead. Schwab's self-help recovery story via repayment of expensive wholesale borrowings drives more durable revenue and earnings growth in the next few years with greater confidence in estimates, writes Morgan Stanley analyst Michael Cyprus, who's had a street-high $148 price target on Schwab stock. Now Schwab can focus on what it does best, serving its customers. Clients are opening new accounts and putting more investing dollars into stocks. The bull market has pushed Schwab's total client assets to $11.8 trillion as of the end of November. That's up 15% year over year. Schwab has seen new brokerage account openings exceed 1 million for 4 consecutive quarters. And Schwab has raked in more than $440 billion in core net new assets last year through the end of November. By comparison, Robinhood Markets' total platform assets are just $325 billion, meaning that Schwab is basically onboarding one Robinhood a year. They're still a great asset gatherer, with one of the strongest positions in the market, says Jeff Schmidt, analyst at William Blair, who has an outperform rating on Schwab stock. Investors like what they see. Shares of Schwab were up 35% in 2025 compared with a 16% gain for the S&P 500 index, and had their largest annual gain since 2021. Despite that, shares trade at a below-market multiple of just 18.2 times 12-month forward earnings, well below the 23.5 times they traded at 5 years ago. That's a more than reasonable multiple given Schwab's strengths. This is a scale business, and when you're the scale leader, you have a cost structure that's dramatically lower than anyone else's, says Alex Fitch, portfolio manager for the Oakmark Select and Oakmark Equity and Income Funds. It's a much more durable franchise than investors appreciate. Working in Schwab's favor are enduring long-term trends. More Americans are trading stocks, and more are seeking out financial advice. Nearly 4 in 10 investors have both advised and self-directed accounts, according to Broadridge financial data. To win more business from DIY investors, Schwab must compete against stalwarts such as Fidelity and upstarts like Robinhood Markets, which recently upgraded their active trading platforms. Other financial service companies like SoFi Technologies and Coinbase Global have been moving into self-directed brokerage. Schwab recently expanded its trading hours and is allowing more personalization on its platform. The goal is to become clients' one-stop shop for all of their financial needs. One way that Schwab hopes to be where clients consolidate their assets is through its forthcoming cryptocurrency offering, set to launch next year. The company will finally allow investors to directly hold Bitcoin and other digital assets and may consider launching its own crypto fund to add to its large, low-cost exchange-traded funds business. The game isn't about individual products, says Citizens JMP securities analyst Devin Ryan, who has a market outperform rating on the stock. It's about being able to get clients to consolidate their assets all in one place. Even as Schwab leans into digital assets and trading capabilities, it's doubling down on the in-person experience by adding more locations to its 400-plus branch office network. Worster says that customer satisfaction typically increases when a client has a relationship with a Schwab financial consultant, and that satisfied clients are more likely to consolidate assets at Schwab. The company's also having success attracting younger investors. About 2/3 of new customers this year are millennials or Gen Zers. Notably, Schwab is steering clear of prediction markets, which have experienced tremendous growth. Prediction markets allow investors to wager on the outcome of events, such as sports. Worster has warned against the commingling of gambling and investing. Other brokerage firms and gambling companies are embracing them. The rise of prediction markets comes as investors have increasingly embraced risk. If the bull market turns into a bear market, that could hinder Schwab's growth. But in a downturn, investors may increase their cash holdings in profitable sweep accounts and seek out financial advice, an area the company continues to lean into. Schwab sees rising demand for advice from investors, especially as they near retirement. Only about 5% of our clients pay us for advice today, says Nisha Hathi, head of Wealth and Advice Solutions at Schwab. That speaks to the opportunity not just broadly, but just within our client base. The company's internal wealth management offering includes a robo-advisor and Schwab Wealth Advisory, its full-service wealth management offering. It's phasing out its hybrid robo-advisor that offers access to human advisors. Schwab also refers customers to registered investment advisors that use Schwab as an asset custodian and for its trading platform and technology. Schwab is the nation's largest custodian, far outpacing number 2 Fidelity, and $81.7 billion of Schwab's $134.4 billion in net new assets reported for the third quarter came via RIAs. Schwab continues to maintain that lead even as new competitors, such as robo-advisor Betterment and tech startup Altruist, see the growth in the RIA sector and try to take market share from Schwab. Plus, advisors continue to choose Schwab when they leave national brokerage firms to launch RIAs. In September, a group of Merrill Lynch advisors who oversaw $129 billion in assets launched Open Arc Corporate Advisory and selected Schwab as its custodian. Emily Fletcher, Open Arc's chief operating officer, cited Schwab's capabilities and Worcester's efforts to innovate, including the push into private markets as among the reason for the firm's choice. As more companies choose to remain private for longer, more investors and advisors are interested in owning shares of privately held companies. Schwab sees an opportunity to scale up Forge's marketplace, through which investors have bought and sold more than $17 billion in private company shares, according to Schwab's announcement of the $660 million deal. Worcester says Schwab can also give investors access to private assets through a fund structure. Plus, the Forge acquisition could help Schwab expand its workplace business. But the real key is bringing more investing customers and advisors to the platform, says Ryan, the Citizens analyst. It can be a customer acquisition tool, but also a wallet share acquisition tool, Ryan says. When Worcester started his tenure as CEO, he used his first earnings call last January to talk up the company's potential. Growth was the byword for 2025. His message for us this year? Keep our foot on the gas and continue to deliver for clients. Just might work out for shareholders too. And now on to the cover story. The best income investments for 2026. We rank 12 sectors, from treasuries to REITs, and why dividend stocks come out on top, by Andrew Barry. Just when income investors were ready to give up on the bond market, it went and had its best year since 2020. The outlook is good for 2026 too, despite some growing risks. How troublesome has the bond market been? Many investors were abandoning the historical 60-40 mix of stocks and bonds coming into 2025 after several tough years for the fixed income side of that strategy. But the blend generated about 15% in 2025 as the S&P 500 index returned nearly 20%, and bonds, as measured by the broad iShares Core U.S. Aggregate Bond Exchange Traded Fund, returned 7%. Income investors had plenty of other choices as well. One highlight, a long-awaited revival in international equity markets, where dividend yields are a multiple of the 1% yield available on the S&P 500, and broad indexes return nearly 30%. In the U.S., most dividend strategies trailed the S&P 500. The Vanguard High Dividend Yield ETF returned 16%, while the $70 billion Schwab U.S. Dividend Equity ETF turned in just 5%. Electric utilities returned 16%, helped by the data center boom, while real estate investment trusts, or REITs, were notable laggards, rising just 4%. Looking ahead to 2026, yields are generally good, not great, in stocks and bonds. Within fixed income, investors can get 3 to 5% yields on municipals, 6 to 10% on junk bonds, 10% plus on private credit loans held by business development companies, 6% yields on preferred stock, 5% yields on mortgage securities, and 3.5% to nearly 5% yields on treasuries. Within the stock market, there are yields of 3% or more on a range of stocks, including pipelines, REITs, telecoms, consumer staples, and pharmaceuticals. That's something, particularly given the S&P 500's historic low yield. Barrons has consistently favored stocks over bonds for income in the past decade, and we're sticking with an equity bias for 2026. Bond yields aren't bad, but they don't offer much more than the inflation rate, now running just under 3%, especially after taxes. Yield differentials on high-grade corporate bonds relative to treasuries are under 1 percentage point, near 25-year lows, and the gap for junk bonds is less than 3 points. We prefer energy pipelines and REITs, which were laggards in 2025 but now look appealing, with dividends of 4% or more and the potential for 10% plus total returns. That could stack up well versus the S&P 500 after the index's 3 straight years of outsized returns. Consumer, drug, cable, and telecom stocks, which are also out of favor, have 3 to 7% yields. They're nice bond substitutes with upside if artificial intelligence and tech falter in 2026 and investors get more defensive. And don't forget cash. Nothing wrong with holding money market funds or treasury bills now yielding about 3.5%. Berkshire Hathaway chairman Warren Buffett loves cash, carries over $350 billion at the company, favoring T-bills over bonds. There are several wild cards for 2026: inflation, the Federal Reserve, and the economy. The Fed is expected to cut short-term interest rates twice in 2026, and inflation, as measured by the Consumer Price Index, is forecast to run at 2.5% to 3%. Any surprises could change the outlook. As Barrons does annually, we rank 12 sectors for 2026, beginning with the most appealing and discuss the prospects for each. We had a good record in 2025. We favored international dividend payers as our top choice, and they handily beat the 11 other sectors. We correctly favored electric utilities and mortgage securities, but we were too upbeat on pipelines and REITs. Here's our assessment of the best places to find income in 2026. U.S. dividend stocks. Dividend-paying stocks had a mediocre 2025, but still offer bond-like yields and appreciation potential, making them an ideal choice for income investors. There are hundreds of ETFs and mutual funds focused on dividends, but 2 of 2025's underperformers are worth a look. Schwab U.S. Dividend Equity, which now yields almost 4%, and ProShares S&P 500 Dividend Aristocrats, which invests in companies with 25 consecutive years or more of annual dividend increases and yields 2.5%. Buying companies with an impressive dividend record has generated strong results over time, but the ProShares fund has had a single-digit return for 2 straight years, well behind the market. The larger holdings in the ProShares fund include lithium play Albemarle, Cardinal Health, and Nucor, the largest U.S. steelmaker, while the Schwab fund is led by drug stocks Merck and Amgen, as well as Coca-Cola and PepsiCo. All 4 yield about 3%. Another approach is to buy the 10 highest yielding stocks in the Dow Jones Industrial Average at the end of each year. That venerable approach did well in 2025, returning 18% through December 26th, 3 percentage points ahead of the Dow. Barrons isn't aware of any fund that follows the strategy, but the Invesco Dow Jones Industrial Average Dividend ETF weights the 30 stocks in the benchmark by their dividends, with Verizon Communications, which yields 6.8%, and Merck, with a 3.2% yield on top. Energy pipelines are number 2. Pipeline stocks don't have much exposure to oil prices, but crude's 15% drop to less than $60 a barrel still sent a chill through the sector. The Illyrian MLP ETF returned 6% in 2025, and individual stocks like Energy Transfer finished the year in the red. The The stocks, however, offer monster yields, dividend growth, and improving balance sheets that enable more stock buybacks. Rob Thummel, a senior portfolio manager at Tortoise Capital, which invests in pipeline operators, sees 10% plus total returns in 2026, driven by 5% average dividend yields and comparable dividend growth. Investors have favored Williams companies and other pipeline companies exposed to the growing market for natural gas, a key fuel for electricity-powered data centers. But with most pipelines now housed in simpler corporate structures, investors can find more yield in master limited partnerships, which generate a K1. Thummel likes Energy Transfer and MPLX, two partnerships with 8% dividend yields. MPLX recently boosted its payout by 12%. For fund investors, the partnership-oriented Illyrian MLP ETF yields 8%, while the Global X MLP and Energy Infrastructure ETF, which limits its MLP exposure to 25%, yields 5%. Closed-end funds like Tortoise Energy Infrastructure and ClearBridge Energy Midstream Opportunity offer even higher yields. REITs, real estate investment trusts, were the worst-performing sector in the S&P 500 in 2025, with the Vanguard Real Estate ETF returning just 4%. This year could be better. J.P. Morgan Securities REIT analyst Anthony Pallone recently wrote that investor sentiment isn't great, but the stocks are relatively cheap with reasonable growth. He sees 10% total returns, driven by a nearly 4% annual dividend and growth in funds from operations, a key REIT cash flow metric of about 5%. One positive is a disconnect between shares of cheaper public REITs relative to private market values. That's driving take-private deals like Alexander & Baldwin, which is due to be purchased by a Blackstone fund. More deals could come in 2026, writes Piper Sandler analyst Alexander Goldfarb. Apartment REITs like Equity Residential and Avalon Bay Communities trade below private market values and now yield about 4%. They could get a boost if investors abandon private REIT funds for public markets, which generally are cheaper, more transparent, and have better balance sheets. Goldfarb favors SL Green Realty, the leading Manhattan office REIT, which is benefiting from the strength in midtown rents. Barrons named SL Green a top pick for 2026 among 10 stocks. Foreign dividend stocks are next. After a decade of badly trailing the S&P 500, international stocks finally had a great year. The run overseas may not be over, as increased fiscal spending and deregulation, particularly in Japan, stand to boost economies and markets. Stocks could also get a lift from a weak dollar, which increases returns to U.S. investors in foreign companies and which President Donald Trump seems to favor. The dollar fell 10% against the euro in 2025. Overseas stocks are cheaper than U.S. stocks, and they yield more than their American counterparts because of a preference among international investors and overseas corporate management for dividends over buybacks. The European stock market yields an average of 3%, Japan 2%, while international high-dividend ETFs like iShares International Select Dividend and Schwab International Dividend Equity yield even more at 4 to 5%. Barrons highlighted the United Kingdom as a good spot for dividends a year ago, and that market's up 30% in dollar terms. Some remaining British high-yielders with liquid American depository receipts include BP at 6%, Shell at 4%, and British American Tobacco at 5.8%. Cable and telecom. Few sectors of the market are as unloved as cable and telecom. The cable story unwound in 2025 as high-speed internet access, the industry's most important product, faced intensifying competition from AT&T's and Verizon's fiber rollout, wireless internet access from T-Mobile US and others, and Elon Musk's Starlink. The wireless industry oligopoly of AT&T, Verizon, and T-Mobile has also grown more competitive as a new Verizon CEO seeks to boost its subscriber base. For income investors, the main plays are Verizon, with a nearly 7% dividend yield, as well as AT&T and cable leader Comcast, each paying 4.5%. Competition remains intense. Barrons recently highlighted Comcast as one of its top 10 stock picks for 2026 due to its low valuation. It trades at 7 times 2026 projected earnings and has an ample dividend. It could also benefit from the potential spin-off of its valuable NBC Universal Media, TV, and theme park business following a smaller spin of CNBC and other cable properties into Versant Media Group at the start of 2026. Private credit, BDCs, is probably the most controversial area of the fixed income markets, and investors get paid for it by investing in publicly traded business development companies, or BDCs. The $1 trillion of loans to private junk-grade companies often carry 10% plus yields at a time when many public junk bonds yield just 7%. There have been some credit cracks in private credit in recent months, though proponents point to what they consider to be strong underwriting standards and ample historical returns. Lower interest rates, which mean less income from the floating rate loans like BDCs make, have forced many to reduce their dividends, something likely to continue in 2026. Yet tough times mean bigger yields. The Van Eck BDC Income ETF, which offers broad exposure to large BDCs, was down 15% in 2025, but now yields over 11%. Investors should focus on BDCs that invest in senior secured loans, the highest credit quality assets in the sector, and it's best to buy one of the many BDCs trading at a discount to net asset value, which offers a cushion. One option, the Morgan Stanley Direct Lending Fund, which has nearly all of its assets in senior secured loans, yields over 11%, and trades at nearly a 20% discount to its NAV. Utilities. Boring no longer, electric utilities are at the nexus of the AI boom, and they're ramping up capital spending to meet growing demand. They're a lower risk way to play data center growth and get a nice dividend. The sector returned about 16% in 2025, but now trades for under 18 times projected 2026 earnings, a wider than usual discount to the S&P 500. The ETF yields 2.8%, but many individual utilities yield in the 3 to 4% range. Mortgage securities are next. Most fixed income markets benefited from tightening yield premiums relative to treasuries in 2025, and that went for mortgage-backed securities too. The result? Returns of more than 7% from ETFs dedicated to that asset class. There's emerging markets debt, a huge and overlooked sector deserving a closer look given attractive returns on debt issued by countries like Brazil and Mexico. The largest ETF, iShares JP Morgan USD Emerging Markets Bond, now yields about 5.5%, while the Van Eck JP Morgan EM Local Currency Bond ETF yields about 6%. Preferred stock, the $350 billion market, is popular with many individuals due to its reasonably high dividends, now averaging about 6%, that usually are favorably taxed. Municipals. Individuals love municipal bonds, but there isn't a lot of appeal in the sector today. Munis with 5 to 10-year maturities and top-grade AAA ratings yield 2.5 to 2.75%. Roughly two-thirds of comparable Treasury yields, which means little after-tax benefit given a top federal tax rate of 37%. And finally, Treasuries, which aren't as dull as they seem, and they have attributes, liquidity, security, some tax benefits, favorable to income-seeking investors. And with corporate bond spreads near their tightest levels in 25 years, the case for Treasuries gets stronger. And with that, we've come to the end of our reading of Barrons for the issue date of January 5th of 2026. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.